Well, hello, good morning, good afternoon, good evening, wherever you are. Welcome to BTA show Breakout Trading Answered, where we talk about all things breakout trading. And of course, we have breakout trading specialist, Tomas Nesnidal. Welcome, Thomas.
Thank you very much. Welcome everyone to the next episode of our Breakout Trading Answer Show. I hope you'll enjoy this one because as usually we have a lot of stuff to cover and I believe it will be quite exciting. So please stay with us the entire hour because I can promise to you it will be worth it.
We do actually have a lot of good stuff to cover today. The title of the show for today is 4 Proven Ways to Filter Bad Trades, which sounds like something good, right? Who wants to keep taking bad trades? Not me. What about you, Thomas?
Not me, no.
Okay, but before we get to that, I just want to do a quick check-in with the community because, it's the end of the first month. We're coming into the close of January in the next few days. And I want to check and see how everyone is doing with their New Year's resolutions. And there's a reason for that. I'm going to share that in a minute. But, hey, Martin, good afternoon. If you're, so let's get a little bit of feedback here. So if you're on track with your New Year's resolutions and your goals, put a yes in the chat. And if you're not on track, you're faltering a little bit or it's a little bit delayed, put an N. And so the reason why I ask this is because, Thomas, have you ever heard of Quitter's Day? Quitter's Day.
Quitter's Day.
Yeah.
Enlighten us, please.
Well, there was a study.
That's my everyday.
I know it's not. I know you're a big achiever.
It's not.
So Quitter's Day. There was a research study done, I think maybe like 2019 or 2018, with over millions of records and people. And what they found out is that I've got the exact statement here. So let me get this right. 80% of all New Year's resolutions fail or are given up on by the second week of January. 80% fail or are given up on by the second week of January. So, I think this is the first show after Quitter's Day. I find that quite remarkable. But I guess it's also, it goes to show that, sometimes it's hard to keep up with our New Year's resolutions. We forget, we're all busy. So let's have a look at the chat. So Martin says, yes, good work, Martin. Alan, yes. Chris, running hard to stay in place. Absolutely. So John, yes. Rob, I don't do them. I don't wait for New Year's to keep my goals going. That's an excellent
attitude that's a good one.
Attitude to have, Rob. So it looks like in our group here, we're all a bunch of achievers, which is great. And we're all continuing on. So well done. And for those who perhaps are faltering already a little bit, don't worry. 80% of people are in the same boat. So, maybe today's show can help you get a little bit back on track in regards to your trading goals. So, Thomas, did you want to add anything into that before we actually get into the show today?
No, excellent. I would just like to greet everybody here. I can see Olga,
Hey,
Rob,
Olga.
Chris, Alan, Martin, Swajon. I don't know. I probably don't see everybody, but that's what I can see right now. So welcome, everybody. Nice to have you back.
Yeah. Okay. So as I mentioned, today's show is about 4 proven ways to filter bad trades. And I think, this is actually quite a good segue from the last show, where we're talking about 3 professional tips for improving your trading results. So, I guess there's an implied improvement in your results by being able to filter out bad trades. So it's a nice segue from last week's show. If you haven't seen that, just head over to the BTA YouTube channel and the recording is there, along with all our other live shows we've done. So, Thomas, where do we want to start with this 4 proven ways to filter bad trades?
You know what? I would like to start. I know we have these 4 points and we'll cover them shortly. But actually, I would like to start with something more important. I would like to start with explaining the concept of bad trades because there's a lot of misconception around that. And please, could you bring up my drawing board? Because I was thinking about this one the whole day. And sometimes in the morning, yesterday I was thinking about this the whole day. And today in the morning, I was like, oh, I must not forget to, especially explain the big misconception about bet trades. And the general misconception about bet trades is that bet trades are losing trades, but that's not the complete truth. So we can have this category like bet trades, category 1, and usually this category 1, it's quite obvious. Like you have some entry point where you take on long position, and actually what happens, instead of going long, you go immediately like this, and then you hit your stop loss. So of course this is considered to be a bad trade. Then also you have some, but then you also have some other scenarios, and that's something that very few traders understand. And that's this one. It's just like we take a long position, we go like this, and then there's a reversal and we hit stop loss. And now we think that this is potentially bad trade just because it went against us. And that's true. It ended up on stop loss, so we automatically consider it as a bad trade. But the point of this bad trade, of the second one, it's not the issue that we would have a bad trade in terms of timing, like in the first case, because the first case, it's obviously very, very bad timing where it immediately goes against us. But if the second case, it's not about the timing, because the timing might have been pretty good, but there's a different problem, and then that problem is called lack of maximum favorable excursion. And that's what a lot of traders do not understand. A lot of traders, they think that a bad trade is just this one, the first case, where we have a bad timing, we enter the trade and we go immediately. The market turns against us immediately. We hit stop loss, very frustrating. I'm with you guys. But the second one is way more often, and it's not actually the problem of timing as we could think, but this is really a problem of maximum favorable excursion. And maximum favorable excursion, if you don't know yet what it is just the amount, usually calculated in dollars, how much the trade comes in your favor before it turns and eventually ends up in your on your stop loss level. So this is called maximum favorable excursion. And now when we think about getting rid of bad trades, it's not so black and white. It's not that just we want to get rid of this poor timing, which is not possible, because then we will have to deploy so many filters that the strategy will be overfit. But it is also about understanding that just timing in an environment where we have a better chance of higher maximum favorable excursion is already a way to filter out bad trades. So we have to think twofold, not only about the timing like direction-wise, but we also need to think about timing the maximum favorable excursion-wise, because usually the sweet spot is somewhere between here. We have win percentage, and this win percentage is related to the first case, which is timing. And then we have this maximum favorable excursion, that's the second part of this chart, which translates eventually into reward risk ratio. And usually good trading, good strategies have a kind of a sweet spot. There can be, let's say, somewhere between 45 to 60% win rate, and the maximum favorable excursion is good enough to create somewhere between 1.5 to 2.0 reward risk ratio. So that's why we need to understand that we need to understand and deploy both these elements, not just have a look on timing, but also on potential of maximum favorable excursion. Okay, does it make sense?
Yeah, it does, and thanks for that. That's a good explanation to put the context around what we're talking about today. So yeah, well done.
Yeah, that's a quite important concept. Of course, when we talk about small maximum favorable excursion, we immediately get to the discussion that with small favorable excursion, we can set smaller profit targets, and thus we can increase the win percentage. But there's usually it goes like when we do it like this, when we have reward risk ratio 1 to 1, then our win percentage can go around 70%. But with 70%, it looks like a good reward risk ratio. But if we risk $100 and if we go with profit target $100, how much do we make on 10 trades? Guys, 70% win ratio, 1-to-1 reward risk ratio, $100 stop loss. How much do we make on every 10 trades?
Do we have any comments in the chat? It's a little bit early for me to be doing math. I haven't even had my coffee yet.
Yeah. So 7 trades will be profitable, and we will make 100 per each. That's 700. And 3 trades will be losers. Which will be 300. So we will end up with plus $400. Now, if we have win ratio just 50%, and it's which is actually flip of coin, and we will have reward risk ratio 2-to-1, then the math is that we have 5 trades where we make 200 on each, so we make plus 1,000, and we have 5 losing trades with 100, so we will end up with plus 500. So that's why, and we make more money. So we think that with 70% win ratio, we're doing better, but we're not. We're doing better even if our chance is 50-50 and we have positive reward risk ratio, we make more money. So the reason I'm showing this one is that the mindset going only after high win ratio is a wrong one. First of all, you're depriving yourself from a lot of money. Second, 1-to-1 risk ratio is extremely prone to slippages and unexpected situation, whereas 2-to-1 is way more robust and can absorb some unexpected situations. And third, it is all about the sweet spot. It is all about the sweet spot, which is somewhere between 45 and 60% with breakout strategies and 1.5 to 0 reward risk ratio. So are we now clear what we mean by good trades and bad trades?
Yeah, I think that's very clear.
Yeah. So that was the introduction, and now let's talk about these 4 ways because they're related to what I just explained to you. So can we bring up the presentation, please, Andrew?
Yeah. Do you want to share all 4 now, or one at a time?
One at a time.
Okay. Let me move the slides before I ruin the surprise. So here we go. First one.
Okay. So the first point, first way to get rid of. Or, well, not rid, that's the wrong wording, to lower our bad trades, the amount of our bad trades. It's quite simple, and it really is very related to what I just explained. And this is using different time frame selection. And I'll explain to you why. Let me just get back to the drawing board. So we already explained in a couple of episodes that using a higher time frame brings significant amount of benefits. And the thing is that when you look at, like, let's say on 60 minutes chart, and you have 3 bars going up, then you have a great with 3 bars, E-mini S&P, 60 minutes going up. Your favorable excursion could be quite reasonable. It can be a couple of $100. Let's say it can be anywhere between $500 to $800 approximately. It depends on volatility, of course. Now, if you think about the same thing, let's say on 5-minute chart, the problem is that these same 3 bars will very likely look something like this. You got me? Do you understand what I mean?
Yeah.
Yeah. So the problem is that wherever you pick timing here on 5-minute chart, you have so much noise, first of all, to fight with. And all this noise not only can anytime go against you, but second, the maximum favorable excursion of any even random entry I pick here will be quite low. So for example, I can pick the entry here, but there can be like, it can be go a little bit my side, and then it can go like here. And that, so my maximum favorable excursion is here, and my maximum adverse excursion is here. And in this case, the market went maybe just 50 or 100 bucks in my favor before it turned against me, which is very common on lower time frames like 1 minute, 5 minute, 3 minutes, and these popular day trading time frames. And traders do not understand. Whereas if I enter somewhere here or even here, of course my stop loss will be a little bit bigger, but also my maximum favorable excursion will be much higher, because a lot of this noise, random noise, is now absorbed in these bigger bars, in these bigger candles, or name it as you want it. So that's why just by swapping time frame and going with higher time frame, that alone will already give you better trades. First of all, you will avoid a lot of noise, and second, you're automatically aiming for a higher maximum favorable excursion. And that's very important, because now with this higher favorable excursion, you can really optimize your sweet spot between win percent and reward risk ratio, which you cannot do or can do very hardly on lower time frames. And besides, these lower time frames are very, very unstable. So that's why just by increasing time frame alone can sometimes be sufficient to already get better quality trades. Does it make sense?
Yeah. So for those who maybe didn't catch that episode or have forgotten, can you, I guess, clarify what you would classify as a low time frame and a higher time frame?
Yeah, that's a brilliant question. So I basically clarify anything up to 10 minutes. I clarify very low time frame. 15 minutes, it's the beginning of a reasonable time frame, although we have very few strategies trading on lower time frames. And anything 15 and higher, I consider with breakout strategies already a time frame which has got a significant reduction of noise and randomness. And there's not necessarily a correlation. It's not that the higher the better. There is some sweet spot, and this sweet spot usually also depends on particular market. But usually the sweet spot is anywhere between 15 and, let's say, something like 120 minutes. That's usually the sweet spot. And then, as I said, it depends on a strategy and on a market. But anything going below 15, we're in a territory of too much of a noise and low favorable excursions.
When you said it depends on the market, what do you think, or why do you think that is? What characteristics of a market have a dependency on the time frame?
I think one of them is definitely volatility, because if you have a volatile market, then on 15 minutes bars, you can have enough of a maximum favorable excursion. And might not be that noisy. But if you have really low volatility market, then even 120 minutes bar might not be enough to give you reasonable maximum favorable excursion. So that could be one logical element. But I think, quite frankly, I know that this will sound a little bit weird, but I think that in developing strategies, there's always a little bit of a mystery included. And sometimes we mysteriously see things that work perfectly on certain market or time period, and we don't understand why. And I have many things that do work or do not work, and I do not have clear understanding why. So I can make up any story I want, but the truth is I do not know. And sometimes I don't know why some time frame is better and other is not. I just don't know.
Yeah. I think if traders, if you see a trader that says that they know why something occurs, usually it's just a personal story, right? We've talked about that before. Humans like to put stories and reasonings around things, and who's to say whether it's right or wrong? Maybe not. Yeah. The data is the truth.
Exactly. And this is still so mind-boggling, because, in our hedge fund, we spend a lot of money on all kind of different researches. And we always started with a hypothesis. And that hypothesis was usually backed by a lot of years of experience, preliminary studies, some pretty major observation, and also some preliminary numbers which show the potential. Otherwise, we wouldn't spend a lot of resources into that specific research. And at the end of the day, after 3, 4, 5, even 6 months of a lot of work, a very, very costly work, we came to conclusion that the whole hypothesis was wrong and that it doesn't work. And it happens with 90% of our research.
Yep.
And it's super frustrating. And I cannot explain why. I just can't. Like, we just see these numbers, and then some guys in my hedge fund, they start asking questions, but why? And the truth is, we do not know. It just, the numbers show that it doesn't work, or it does work. And sometimes we just do not know. So we respect the numbers, we go with the flow, and sometimes we just do not know.
Yep. Does it even matter?
Doesn't even matter. Yeah.
Yep. Okay, so that was
time frame.
Yeah, time frame, main time frame selection.
Is it clear?
Yeah, we don't have any questions in the chat or any comments. If you got a question for Thomas, just post it there, and we'll get him to answer it. And in the meantime, I think we can jump
to the second one. Yeah,
go to the second point. Yeah.
You need to show the slide again because I don't remember the second one.
Here we go. Here's the second one. Ta-da!
Oh yeah. So this is a really good one, and I use this one a lot, and I mean really a lot. So this is not new. There's a fantastic book from Larry Williams called "Long-Term Secrets to Short-Term Trading," and in this book, Larry Williams he explains a few key concepts, very simple concepts, and these concepts are basically these concepts are related to some overall pretty empirical behavior of markets, which is, although this book is 30 years old, these principles are still valid until today. So, for example, one of the reasons is that Larry Williams says in that book that we have periods of low volatility, then we have periods of high volatility, low volatility, high volatility. And this is where we make a lot of money, and this is where we lose money. And the trick is that we never know which one will be the next one. But what he really so he's got a couple of concepts like this. But what he really says, okay, we do not know which one will be next. We cannot predict. But what we can do at least is that we can start really having at least using these as a choices to filter our trades. So he says, if we know that after low volatility, with every other day or with every new day with low volatility, there's a significant increase of likelihood of higher volatility, and higher volatility is where we can really make a lot of money. Then he comes with a couple of concepts in that book where he says, okay, let's wait. Let's just see how we can play potential entries in different let's do like kind of a fishing for a higher volatility in low volatility condition, which is pretty neat concept. It doesn't work with all markets, but it alone is pretty neat concepts. And other thing is that when we have some basic time frame like the 60 minutes, we have a strategy which works pretty well or reasonably well on some 60 minutes time frame. And on these 60-minute time frames, we're lucky that sometimes we have good entries with not so big a maximum adverse excursion and a decent maximum favorable excursion, and that's how we profit. Now we already understand that maximum favorable excursion, it's one of our keys to getting good trades. Now the thing is that getting good maximum favorable excursion is of course easier in these higher volatility markets because that's where the maximum favorable excursion is. So one of the things is that we can keep the strategy as it is because obviously even on 60-minute time frame, we can already do a great job. But what we can do, we can deploy second time frame, and this second time frame can be daily. And in this daily, we can add some very simple indicator, like let's see ADX. That's one of my favorite. And this ADX indicator basically tells you have some level, usually around 25, and anything above, sorry. And anything about 25 is considered to be a healthy trend. Anything below is considered to be no trend. And it's quite interesting. And again, this doesn't work on all markets, but one of the things that you can really do, you can set a filter that you start timing your entries only if your daily last close daily bar, if the ADX, some reasonable periods like 14, is below 25. And now this really sounds very, very counterintuitive, because that's exactly where the maximum favorable excursion is not. However, sometimes it's very surprising that if we time our trades in this minus area, we're just this explosion of volatility is just behind the corner, and we're actually timing better for maximum favorable excursion, for higher maximum favorable excursion. And sometimes it's the opposite. Sometimes with some market only is just we deliberately prohibit any trades below 25, and we only want to stay in this higher environment. The beauty of this is that we can deploy this indicator on higher time frame like daily, and we don't even need to optimize it much. We stay with 14 period like there 14, that's it. We do need to change it, and we might just try levels like 20 or 25, alternatively 15, but I usually just trying 25 is enough. So we can just try this filter on our strategies on daily time frame, and the likelihood of overfitting, although it is present because we are already adding another element, but overall it's lower, because first of all, we're not really optimizing, and second, we're deploying a completely different secondary time frame, and we already know that the base strategy does work without that. So we already have a workable strategy on the main time frame, and the only thing is that we deploy this second one, and because the base already does work, there's not that much that could go wrong, although there's always something that could go wrong. But in this case, there's not that much that could go wrong. But at the same time, we're really saying, okay, let's do a better timing, because some markets will get better timing in low ADX, and some markets go in higher ADX. And this way, we immediately can again do better timing. We can do better hunting for higher maximum favorable excursion, and thus we can reduce our false trades.
Yeah, so in this case, you're talking about ADX, which is I guess a measure of the strength of the trend. What other kinds of concepts do you like to look at, or have you found tend to work on this daily time frame?
Yeah, that's a brilliant question. So, for example, there are a lot of statistical, let's say, not necessarily edges, but statistical occurrences which keep happening again for a long time, or I would say 15, 20 years, and you still see them. And these are kind of circumstances with strong statistical edge, and these circumstances give you a higher probability of happening something. And it also depends on market, because each market has got a different one. But for example, on indexes, this is a pretty robust one and pretty frequent one, is that if the previous day was a low day, that means it closed, the close was lower than open on the previous day, then there is a statistically higher probability that the next day will be up day. And that condition alone cannot be really anyhow optimized, because that's a fixed condition on daily time frame. But if you use it just on indexes, this condition alone already can give you pretty good potential to reduce your false entries and false trades. And that's the kind of conditions I like as well. These conditions that can be coded without any optimization input. So whatever we can do, and these price patterns can be quite good, because we can come up with few of them, and they have no optimization input. thus we're not really increasing the likelihood of overfitting and over optimization. So in general, I personally like using this price action and ADX. I do not like using all the kind of indicators. I believe that once you start trying, like you take 20 different oscillators and you try all the oscillators and all the different ranges. First, you're cherry picking. Second, you're overfitting, and that's where you're in trouble. Whatever the result it will be, it is already a lot of that data mining going on. So that's what I would avoid, and I would just stay with these very simple concepts.
Yep. Well said, Thomas. Thanks for sharing that. No comments in the chat or questions just yet. So if you got any questions for Thomas, please post them and we'll get to them. So is that the end of point number 2, higher time frame and daily and daily conditions. Yeah, we got that.
Yeah,
right.
so this is daily condition, right? Like I explained, this is on daily chart, so this is daily condition, and this is just a like regular condition on highly time frame, but this is mainly what I wanted to talk about. Yes.
Yep.
Sorry for my drawing. I know it's horrible, but I think it serves the purpose.
It's good. I like it.
Okay. Fire.
No, I'm not lying. It's something very different. I find it quite engaging. Okay, so that was point number 2.
Yes.
Number 3, I'm looking forward to hearing this one. Let me put this one up on the screen. Drum roll. Confirmation bar technique.
Yeah, this one is so simple. Yet it works. It works with some market strategies. It works really well, and it almost sounds obvious, but it's not. It's not really considered often. So one of the things is that when we have some entry point, and again, let me do my beautiful driving. So let's see, we have some good breakout strategy, and this breakout strategy has got some basic condition on pullback, and then we have a pullback, and then once the pullback occurs, then we set in stop order for some reason on this entry level. Now, what the market does is that once we trigger this entry level, we're long. Now, what is quite interesting that, of course, the last known bar, closed bar that we know is this one, because when we're triggering the stop order, this one is still developing. So this is the last known closed bar. It's really surprising that sometimes just taking this bar and looking if this is an up bar, which means that close is higher than open, this condition alone pre-qualifies the entry, because this condition alone tells you we're probably already in an uptrend because the last bar closed higher, and that condition alone can already give you pre-confirmation that there's a momentum in the market. Now, so this is what I call the entry bar confirmation. Now, the nice and funny thing about this one is that now when you know that this bar, the last completed bar before your actual entry, can give you an idea whether we're on the right path, you can start playing with this bar. So one of the things is that you isolate this bar, and then you can start developing conditions like you need to close in top 20%. So this means that we really have a strong bar, because in certain cases you can have just open here, close here, but that doesn't necessarily mean that we had a strong upward momentum. But this one, if we, for example, have closing in top 20 or opening close 20, top 20, so if we start playing with the quality of this entry bar, we can do something like a preliminary check whether it is a momentum. And now do not forget that we're talking about 30-60 minute bar. So this kind of a movement on 60-minute bars does already tell you something about momentum. It's a different story on 5 minutes, because on 5 minutes it's very noisy and we have plenty of random bars like this one. But if we're talking about 60-minute time frame, we need some serious momentum to create a bar like this, which opens low and closes high and is pretty much green. And if we have a bar like this, at least we have some preliminary pre-confirmation that we already have a momentum in the market. Because what can also happen, sometimes we can have this down movement, and here would be our entry point. But we can really open here, and we can close here. So that could be another quality. And now this can be so-called turnaround bar, but it can also be a beginning of a noise. So this, because sometimes this is on a candle, this is doji, and doji bars are followed by dojis sometimes. So it doesn't really give us enough of a confirmation that we're potentially working with some tradable, reasonable momentum already. So that's one thing. The other thing is that if we want to take this concept even one step further, and again, this really depends market by market, strategy by strategy, then we can set a condition that we need to have at least 2 bars going up, or that the last closed bar, and that's something I sometimes use because that's a good one. So the last closed known bar needs to have higher high than the previous one, and higher low than the previous one, because now we can see this configuration, which again gives us a preliminary pre-confirmation that we're getting momentum in our favor. And again, this is really simple. There's not much of a potential to overfit, although there's always potential to overfit. And sometimes just this simple bar confirmation, entry bar confirmation, or let's say even rather pre-confirmation deployment can again give us some good filtering of potentially weak trades.
Yeah, I like this. This technique is quite clever. I think a common question around this technique, though, is if you're waiting for these confirmation bars to occur, whether it's 1 or 2 bars or 3 bars or whatever, you might be getting into the move late then, because you're waiting for something to happen first. What do you say to that?
It's totally, again, this is really individual. It depends strategy by strategy, market by market, and it can sometimes happen. But again, now you have the opportunity to play with this even further. Now you can say, okay, how about if I have configuration like this? If this is the last known close bar, and before that I had lower low and lower high, but before that I had higher high and higher low, I'm making this U shape, which is basically swing, and maybe this configuration will give me right in time the earliest possible, because now we're working just with this U-turn. So it's just up to you what all you can come up with. But you don't get me wrong, surprisingly, and this again, it's one of the mysteries, surprisingly, just this one alone, the simplest one alone, can already give you good banks for, how you say it, good bucks for your buck. Yeah, good bang for your buck. And it's the simplest one without any fancy stuff.
Right, okay. And so with this technique, do you only ever use like the pattern, or is there some other data you might look at, for example, volume on a bar or an indicator level on a bar? Or is it just...
I never looked. I always look just on the configuration alone. But I think the idea of volume is actually pretty good. Never got on my mind, but it's pretty good. Yeah, that could work as well.
Yeah. I know some day traders look at that as a confirmation for a breakout, is they look at the volume of the previous bar. So there might be something in that.
Yeah, that's a good idea. That's definitely something to investigate. That could be interesting.
Yep. Okay. I just posted a question in the chat if anyone's using this technique, and Rob said he, as related to candlestick patterns, he does use this. So it's a very powerful technique, I think, and quite simple. It's quite simple to implement.
But again, it's very unpredictable on lower time frames, because lower time frames, if you have like 3-minute time frame, just 1 second delay with your data can turn your doji candle into a regular upwards candle. And that's just because you missed one tick, or your internet disconnected for 1 millisecond, and you already have a different configuration. So that's why it's quite unreliable. But if you play with these higher time frames, it's pretty reliable already.
Okay. Thanks for clarifying that, Thomas. So that was confirmation bar technique. Doesn't look like we've got any questions in the chat about that one as well. So you're super clear today. Do you want to move on to the fourth and final point?
I'm probably super clear because I'm using this fancy technology, and I really enjoy using this fancy technology, I have to say.
Okay.
The last one is without the technology. That's just plain slide. So if you can bring it up. Yeah. So the last one, some of you guys do already know this, and you already have this. So the last one is the most sophisticated one. As we already talked about at the beginning, it's all about the good timing. And we really deconstructed in our hedge fund, and I started with that work already a long time before my hedge fund. We deconstructed different levels of timing, because timing, it's quite a vague term, but there can be different levels of timing, and you can do timing in different components, ways, and levels of your trading strategy. You can do general timing, like day of week general timing. That's so general, yet it is already timing if you time just for specific days. But then you can also have system timing, where you already time better with something built into the system itself, like this entry confirmation bar. That's already in system level timing. You're already working with better timing right in your system. Then another one is a volatility level. So now you can also bring in volatility and start with different timing according to volatility. And lastly, you can have called market timing, which is more based on some particular market quality or market configuration. Market quality is probably the best word. So the point is that as a complementary to these three techniques that I just explained quite in details, there's also a quite complex world of another 4 levels of timing. And we're not going to this because, first of all, we're almost 45 minutes. And second, this alone, it's a quite extensive and serious know-how that we put a lot of effort in. And if anybody would be interested to really learn about these 4 techniques in details, including codes and including the exact way we implement it in our hedge fund, then we have a special package, which is called Smashing Force Breakouts. And it's basically everything that I presented today, this is next level. So this is like we work with concepts on the next level, and we go deeper and with way more, I would say, high level concepts. So that would be my 4th tip. If you really are into reducing your force entries, go to the web I put below and check this one as well, because we already know that it works very well, and we have great success stories from our students with this one as well. Yeah. So that would be my last tip, the timing pyramid.
Okay, great. I'm just seeing if I can copy that link into the chat to make it easier. Here we go. There we go. Okay, so that was the timing pyramid. Nothing else to add on that one, Thomas?
Now I'm happy to answer timing related and force entries related questions before we move to the quote of the day.
Yeah, okay. So we don't have any timing questions in the chat, but we do have some general trading TradeStation questions. I know you love TradeStation questions. So maybe we'll just jump to those and then we can do the quote. So we got two questions here from Mark. G'day, Mark. Thanks for joining us today. This first one, here we go. Let me put this up on the screen. This is a common question, actually. In TradeStation, how many strategies can be used safely in a single workspace?
I don't know exact numbers, but in one single workspace, at least dozen without any troubles from my experience.
Yep.
We have one portfolio in a hedge fund with 120 strategies, but this is distributed among 4 different TradeStation instances, but I don't know among how many workspaces. I don't really know how I don't know this all is managed by my hedge fund team, so I don't know how they manage that. But from my past experiences, I easily could run at least a dozen or 15 strategies in one workspace without difficulties.
Yep. And then the next question from Mark is related. Approximately how many workspaces can be safely open for live trading?
Again, I had experiences. What I used to do in my private trading, because now I only trade my money in my hedge fund. I used to have one workspace for each market category. So I had it for indexes, for bonds, for metals, for grains. So it was like 8, 9, and then I had all the different strategies in markets in every workspace. So I think quite a few, definitely a dozen, 15, 20. I think honestly, Mark, I think this is maybe a better question to ask customer support in TradeStation. They probably know better limits. I haven't tested limits of TradeStation in this way.
Yeah, this tells me that Mark's got a good problem. He's got a lot of strategies to trade, and he's just trying to figure out how to do it. So well done, Mark. If that's the case, then it's a good problem to have, right?
If this is the case, that's a brilliant problem to have. That's great. Yeah.
Yeah, better having too much than not enough, I think.
Absolutely.
Okay, so I don't see any more questions in the chat right now, so we can go to one of my favorite parts of the show, the quote. Do you want to do the quote now?
Yep.
Let me just get this up on the screen. Okay. Go ahead.
Timing is everything. When you're really ready for it, it will come. And I love it because this quote is said in a daily life. Like, we hear this quite often, like, wait, it's all about timing. When there will be the right time, it will come, which is true. Sometimes sometimes we have to be very patient and really wait a long time. But I think this applies for trading very well as well. The reason, the difference between normal life and trading is that the readiness for it in trading can be manipulated in our favor. You cannot manipulate life so easily. You can increase your odds in certain ways, but you cannot manipulate your life as easily as trading. But with tradings, you can really, with a few clever, simple tricks, including this I shared with you today, you can set an environment where you really increase the favors that you're just set for things to come in your direction. So that's why I think it's easier to create good timing in trading than in life.
Actually, this quote reminds me of a bad joke or a silly joke. Do you want to end on a stupid joke?
Yes, please.
Let me see if I can think of the wording. So, okay, here we go. What's the most important part of a joke? The timing.
Okay.
So there you go.
Yeah. Something
That's
like
pretty
this,
bad.
exactly.
Yeah.
Yeah.
So you get the timing
Something
wrong, and
like
it
this.
just all falls flat, right? It's no good.
Of course,
So
but yeah.
all right. Well, we've got
Yeah.
a question here from Mark,
Mm-hmm.
and let's put this one up on the screen. Can you give an example that illustrates the difference between general timing and system timing?
Yeah, I already gave that example. So, for example, general trading can be related to day of week because that's very general. It's not related to the system itself. It's rather related to general time in a sense of part of the trading session, day of the week, month of the year. That's general timing because we're talking about general time. Whereas system, it's something built into the system. So for example, the confirmation bar is a system level timing because now we're working with a better timing right in the system, on the system level. We're not trying to figure out the general timing as it's set by clock of the universe, but we're trying to work it out just right on the level of the trading system.
Yep. Okay, hopefully that answers your question, Mark. So it looks like that's all the questions we have for today. So we can start wrapping up. So thank you, everybody, for joining us. If you enjoyed the show
Thank you.
and got some excellent insights from what Thomas has shared today, please remember to give us a thumbs up on the video. Ding! I'm like a little sound effects guy today, aren't I? And maybe we need to get some sound effects for the show.
Especially if you like my drawing, please give me a thumb up.
Actually, Rob said in the chat that he likes the drawings. They're really helpful. So I agree with that, Rob. So,
Great.
Yeah, give us a thumbs up and don't forget to subscribe. We're just about to start releasing some additional content, I think, in the next week or two, right, Thomas? So if you hit the bell to be notified, you'll see, you'll be notified when that comes out. So we've got getting some thanks in the chat for today. So thank you again, Thomas. Okay,
thank you, guys.
Let's put a couple of things up in the chat to finish off. And
yeah.
If you got any closing words, Thomas, you're welcome to say. So thanks, guys, from Mark.
Thank
Rob
you, Mark.
Stead. Thanks, guys.
Rob.
Oh, actually, Rob has got a second question here. Question, a comment. Another hour that really flew by. I have to agree.
I agree. Yeah. I agree, Rob.
So
thank you for being here. Great.
Yeah.
Pleasure.
So that's all for today. Thank you for joining us, and we'll be back in 2 weeks' time with. I don't think we know what the topic is yet, do we, Thomas? We got to figure that one out.
It's secret.
Oh, it's a secret.
Yes.
So secret. Thomas hasn't even told me. So there you go. We're all in suspense.
Yeah, including me.
Yeah. Okay. So thanks again, everyone, and stay safe. Have a good couple of weeks, and we'll catch you again soon.
Yeah, love your enthusiasm, guys. Just stay on your path. We'll crush it. See you soon again. Have a great week. Thank you very much. Happy trading.
Cheers. Happy trading. Bye-bye.